Technology shares are going to be the real focus this morning with that announcement expected imminently by Verizon that the iPhone will be available on its network. And I'm just taking a look at Verizon shares right now, down by about 1% ahead of that announcement. Well, I'm joined by two technology experts. Bill Wyman in D.C. is head of technology research at ISI Group. Last time he was on with me, he said Apple was one of his top stock picks, and it's gone up since then. That was last year. Also with me is Ted Moore of Fifth Third Asset Management, which has $18 billion assets under management and about 1.5 million shares of both Verizon and AT&T. And Ted, don't you also own Apple as well as Google?
Well, Fifth Third Asset Management owns several of these stocks. The only one of them that you've listed in our fund is Verizon.
Is Verizon. Okay. Let me start with you, Ted, because I believe you said, right, from my notes here, that you think this is going to be worse for AT&T than many of the markets are expecting?
I do. I think that there's an expectation of defections from AT&T to Verizon of maybe 2 million subscribers a year over the next couple of years. I think it could be higher than that. I think it'll be more like 3. And in the near term, that's actually dilutive to Verizon and helpful to AT&T for near-term earnings. But over the long run, of course, higher subscribers, upgrading to smartphones is better for your business. Right.
It's gonna hit AT&T. Bill, is that something you would agree with?
I would, and I think the focus shouldn't just be about the iPhone today, but the tablet. The tablet is really going to be the bigger source of earnings growth over the next couple of years.
Okay, what do you mean by that? Expand on that for me.
So the iPhone investors are understand the drivers here. Apple has about 20% of the market. Smartphones themselves are already crossing 20% of the market itself. So in other words, we have deeper penetration. The tablet's just getting going.
Right, the tablet is just getting going. Ted, then given that, are you going to buy more shares of Verizon, or is all of this already priced in?
I think a lot of it's priced in. We've seen, pretty minimal reaction in the last few days. The actual date of the Verizon iPhone has been a very well-kept secret, but the fact of a Verizon iPhone has been probably the most anticipated event in tech and telecom over the past year at least. So there's not a whole lot of excitement left for the stock. But again, what matters now is how they perform relative to expectations, and we still believe that the consensus is underestimating the effect.
Underestimating? What do you mean in terms of? You're talking about the performance?
We think there will be more incremental value to Verizon than people are anticipating from the adoption of the iPhone.
You mean that there's going to be more phones sold, or that there's going to be bigger margins, or what?
More phones sold. They're going to gain an advantage that they didn't have. They already have what we would characterize as the best network, and now they'll have the best phone, which is something that had been holding them back. Again, though, Verizon Wireless they only own 55% of the joint venture. They have a wireline business. They have a lot else going on, but we still think that it's an incremental positive.
Bill, I cut you off. What were you going to say?
No, this is Ted's brought up a number of good points. I think the broader issue, right, is not just about the iPhone, not just about Apple and Verizon, but this has become a bellwether for this broader notion that we're moving from a wireline PC world to a mobile devices connected with internet services. And Apple and Verizon in some ways represent that. And that then becomes a catalyst for a much broader set of opportunities around a mobile interconnected world. And I think for 2011, that's where we're going to see more of the opportunities. In other words, we're moving beyond just better devices on better networks, but some of the applications and services that ride on top of them.
Right, so then that lifts all boats, right, Bill?
For the wireless ecosystem, yes. For example, the semiconductor chips around communications would be a beneficiary here. If you look at things like mobile advertising, we think that will start to take off as well. Google, clearly a beneficiary there.
Okay, so those are some of the names. Bill, I think, makes a good point that we've been hearing quite a bit on our program about, which is everything going wireless. And I know, Bill, you've been very big on cloud computing than Ted. Do you think from beyond Verizon that there are more opportunities for you in that area, and what would they be?
Bill brings up some good points. I think most of the stocks that will be benefiting would be characterized as growth type names, whereas we're a value fund, so we're not going to get a whole lot of these companies at 10 times earnings. But I fully agree, and Bill has a great track record of looking at future developments in tech.
Okay, Bill, then before we leave you, give us some ideas on where you think that space is going. Where do you think the stocks are going to perform? And we'll have you on back next year and see whether they did.
Right. Well, thank you. I mean, I think a big theme for 2011 is going to be this dichotomy between the big cap tech stocks that largely underperformed in 2010 versus the secular growers that Ted was pointing to that really did well, but that by conventional metrics are quite expensive. We would just selectively add to some of the big cap names. Google and Oracle would be two that we would look at from a growth outlook. But I'd be selective because big cap tech is cheap because growth is slowing. And then you would continue to stick with the secular growers. In every era in tech, it's the secular growers that outperform. And to outperform in tech, you really have to own them. So we're going to selectively add to some of the big cap tech and then stay with the secular growers.
Okay. Bill, thank you so much. Appreciate it. Bill Weinman of ISI and also Ted Moore of Fifth Third Asset Management.